So before starting the presentation, I would like to thank the Tax Symposium conference organizers for giving me the opportunity to present my research work. The research paper is titled as Base Erosion and Profit Shifting and FDI Inflows, the experience of lower middle income countries. So before starting, I will give you a brief of what this research is all about. This study investigates how FDI originating from tax havens compounds physical stress in lower middle income countries by eroding their tax base. Amid aggressive tax competition to attract investment, the profit shifting enabled by tax havens systematically undermines domestic revenue mobilization, contrasting sharply with the impact of FTA from non-haven OECD countries. This comparative analysis highlights the critical challenges lower middle income countries encounter in mobilizing sustainable development finance within an increasing globalized economic landscape. So many of you were familiar with the term lower middle income countries. It is according to the World Bank classification that the countries with GNI income per capita between $1,136 to $4,495 is coming under the bracket of lower middle income countries. So, as all we know, before the globalization, that is before 1990s, especially developing countries have a lot of protectionist policies to protect their domestic industries from foreign competition. But there are also a problem of low savings and low investment by these developing parts. So after the introduction of globalization and liberalization phenomena, many countries, especially lower and middle income countries, actually opened their economy for foreign capital, technology, and many other things. So the main aspect is that if a multinational is going to invest in a developing economy, the employment will be generated, productive capital will be enhanced. So it is seen as the true engine of development. So foreign direct investment plays a vital role in enhancing economic growth in developing countries by providing capital inflows, technology transfer, and access to global markets. And we all know some tech giants like Samsung, Lenovo, Petromax. All these tech giants are investing a lot of money into developing economies. So MNC-led FDI promotes employment, infrastructure growth, and productivity, driving long-term structural transformation. In the latest released World Investment Report, developing part accounts for 57% of total FDI flows by multinationals worldwide. And studies suggest that FDI inflows enhance tax revenue in developing countries. So comparing to the developed parts, developing economies rely more on tax revenue to finance their escalating expenditures. For developed parts, tax revenue as a proportion of their GDP is around 37 to 40%. For developing countries, it's around 18 to 22% from 2000 to 2022, which raise concern about the adequacy of their tax base. Coming to the corporate tax revenue in proportion to GDP, for lower middle income countries, it remains below 3%, and for high income countries, it remains above 3.5%. So there is a disparity. Now I will explain how FD is related to profit shifting. So there is a term called tax haven. I think some of you are familiar with the term tax haven. It means the location or some countries in the world with very low tax rate, high financial secrecy, and lax tax rules and regulation. And for the matter of fact, better administration. For example, Luxembourg, Netherlands, Cayman Island, and GCC country like UAE can consider it as tax haven. So this multinational giant will establish a paper company in tax haven, and they establish a subsidiary in a lower middle income country. For example, I will take my country, India. They will establish a subsidiary in a country like India and make a significant amount of FDI investment. How they are doing profit shifting is very interesting. They transfer goods and services at a higher rate to the Indian counterpart. And they also give the right to use the patent and trademark to Indian counterpart. And they also lend loans. In return, Indian counterpart give transfer payment, give royalty payment, and interest payment. So all this payment leads to the reduced tax liability. This is how the profit shifting works. So I will give a standard definition given by OECD in 2013 development report. It's actually the policy report of OECD. Base erosion and profit shifting refers to tax planning strategies that exploits gaps and mismatches in tax rules to artificially shift profit to low or no tax location where there is little or no economic activity, resulting in little or no overall corporate tax being paid. So before 7 to 8 years back, we all see the Panama paper leak, Pandora paper leaks. We see that millions of dollars of profit are being shifted to tax havens by some wealthy individuals, by some tech giants like Google. We saw that. And coming to the global statistics, 8 to 10% of total corporate tax revenue was lost due to profit shifting activities in the year 2022 alone. This I'm quoting from Global Tax Evasion report by Global Tax Observatory. And developing economies experiencing an annual loss of around 100 to 240 billion dollars. So there is a sluggish growth, which reflects inefficiency in taxing multinational income in developing nations. Then I will give you a little detail about what is tax havens. It's a jurisdictions with no nominal tax attracting non-residents to escape tax liability. According to OECD classification, there are around 43 tax havens. There are four criteria which is related to tax, which is related to lack of effective change of information, lack of transparency, and no substantial activities. In literature, we can see that there are contrasting views regarding tax havens. The literature of Slumrad and Wilson have a view tax haven as a parasite on the tax base of non-haven countries. It facilitates MNCs to transfer profit to paper companies in return for concealment fees. And this competition is leading to race to bottom tax competition, which will adversely affect developing economies. But Deshai's literature has actually a contrasting view on tax haven. They view tax haven as improving efficiency by minimizing tax burdens, freeing capital for productive uses. So this is the framework which I developed my paper. There is an international tax competition where countries all around the world actually make adjustment in their corporate tax rate to attract more FDI. So there is an MNC headquartered in a developed economy, and they establish a shell company in tax havens using the lax tax rules and regulations. And that shell company, which will reduce a subsidiary in lower middle income countries through FDI investment, and through that three profit shifting channels, that is transfer pricing, royalty payment, and interest payment, profit is repatriated to shell company, which will increase the accumulated profit of the consolidated balance sheet of the company, which will ultimately increase the share value of the company globally. But the tax base is distorted of the lower middle country. This is how the profit shifting framework works, and it will become more complicated if an MNC establish more and more paper company in many tax havens. It will become more complicated, and that distortion of tax base will be in an increasing manner. And coming to the literature, Hines and Rice 1994 paper actually pioneered the empirical foundation for the calculation of base erosion and profit shifting. So they calculated a ratio known as semi-tax elasticity function, which means that the percentage change in profit reported in response to the change in corporate tax rate. And they found out that the abnormal profit reported by US companies in tax havens in 1982, and they find out the tax semi-elasticity of 2.83%. And when we look at the channels and the literature on the channels of profit shifting, now look at the channel of transfer pricing. Firms systematically overprice imports into high tax countries and enterprise exports from high tax countries, artificially reducing taxable profits in high tax jurisdictions. And it's more prevalent in industries with intangible assets where enforcing transfer price ruling is difficult. And coming to the literature on royalty payment, MNCs disproportionately hold intangible assets in low tax jurisdiction, and a 1 percentage point decrease in country's corporate tax rate increases the likelihood of MNE holding intangible asset by 2 to 3%. And it is more volatile in the context of digital economy. It will be more prevalent in the case of digital economy because there will be no need of a permanent place of business. Coming to the channel of intradebt, MNEs increasingly increase their internal debt in high tax subsidiaries to exploit tax deductible interest payments, artificially reducing taxable profit. So the existing thin capitalization rules are partially effective but insufficient. This is how the literature works, and I will briefly explain the empirical literature. So there are mainly two important studies which I will explain. First one is focused on European countries by using an 11 in 2008, and they studies how MNCs shift profit across countries in response to tax rate differential, and they found a semi-tax elasticity of 1.31%, and they found a significant redistribution of tax revenues in Europe and calls for harmonized tax policies. In the context of developing economy, Preveli and others in 2016 studied about the cross-border spillovers of corporate taxation through investment decision, and they found that 1.3% of the world GDP is affected by profit shifting, and they estimated a loss of $650 billion loss. And again, they called for a greater international coordination, not a country-wise solution, but a greater international policy action regarding this. And Cobham and Jansky actually re-estimated the earlier study and calculated a lower estimate of $500 billion. And the latest kind of studies by Bernardo and Jansky in 2023, utilizing CBCR data, and found out that $850 billion were shifted globally in 2017. And developing countries are more vulnerable to tax avoidance than developed ones. And interestingly, there exists a negative relationship between level of development and exposure to tax avoidance. So these are all the literature, and there are some criticism. The data of multinational companies' transactions in developing economies is massively underrepresented in Orbis and Amadeus databases. And the empirical frameworks developed for OECD economies are often applied without adjustment to the structural and economic realities of developing countries, which leads to underestimation or biased result. And the corporate tax revenue that does not show considerable growth with FDI has to be addressed in the context of growing physical needs of developing countries' economies. So lower middle income countries, which represent 40% of global population, is received limited attention in the empirical research concerning the stagnation of corporate tax revenue. So this profit shifting actually fuels tax competition. It compromises fiscal capacity and intensifies inequality. So the basically two pressing question remains. Is there any differential impact on FDI flow from tax havens against OECD countries on the FDI outcome of lower middle income countries? If impact exists, what are the subsequent tax revenue losses due to profit shifting activities? Before going to the estimation part, I will give you a brief statistics about what is the share of FDI from tax havens in lower middle income countries. If $100 is coming as FDI in lower middle income countries, how much the tax haven represents? In 2010, it is around 38.50%. It is in a volatile manner up to 2018. In 2017, the historical Tax Cut and Job Act by Trump administration came into force in 2017. So we can see a net dip in 2018. But it reaches the historical peak of 44% in 2021. And in 2022, due to the global FDI slowdown, it became 43.61%. So majority or 43% of FD to lower middle income countries is represented by tax havens. This is the fact which we have to keep in mind. And coming to the FD from OECD, we take around 24 OECD countries. It's around 1 to 1.2%. It's very negligible compared to tax havens. And the estimation part, we use the global baseline methodology mentioned in the World Investment Report and the Jansky and Palansky 2019 estimation model to analyze the effect of inward FDI sorry, from tax havens and OECD economies on the components of FDI income, such as overall income, its equity component, and interest payments of lower middle income countries. And the time frame is from 2010 to 2022. Concerning the after impact of global financial crisis, where offshore financial center acts as central port. And it's also the period when the OECD action plan to tackle profit shifting was implemented. So coming to our first model of lower middle income countries, we assume a negative relationship between FDI from tax havens on total FDI income and its equity component, and a positive relation between tax havens FDI and an interest payment. So all the three channels, that is transfer pricing, uh, royalty payment, and debt channel, is covered in the three variables of interest. And our controls are corporate tax rate, trade openness index, and control of corruption index. The data for all the variables are sourced from IMF balance of payment database, IMF coordinated direct investment survey database, and World Bank open indicators. In the case of OECD countries, the exact opposite assumption is taken. We assume a positive relation between FDI from OECD countries on total FDI income and its equity component, and a negative relationship between OECD FDI and interest payment, and the controls are all same. This is a summary statistics which I'll not spending so much time. This is the basic baseline regression results, which means that 1 unit of FDI from tax havens is causing negative 3.8 unit change in total FDI income. And at the same time, 1 unit of FDI from tax haven is causing negative 3.7 unit change in equity income. In contrast with the literature, the interest payment channel is very weak and it's showing a negative sign. And trade openness index is the only control which showing significance in the two variables of interest. And coming to the OECD results, even though it is not negative, it is not showing any significant results. So the FDI from tax havens is showing a negative result, and FDI from OECD is showing a non-determinantal effect. This is the baseline of the basic baseline regression results. And the next step of my research paper is I am appropriating that ratio into tax revenue losses, which is given by the equation given by OECD, given that corporate income tax revenue losses is given as average tax haven exposure of total inward FDI stock into reported FDI stock into responsiveness of reported rate of return on tax haven investment, which we calculated from that ratio, and transforming the after-tax value into pre-tax value, which is because FDI is given as after-tax value. So we have to convert into pre-tax value into weighted average effective tax rate, which will vary according to each year. So this is the result. In 2010, lower middle income countries in total lost around $4.36 billion, and it reaches the high of $6.76 billion in 2015. So we can divide this result into two: 2010 to 2015, that is pre-action plan period, 2015 to 2022, post-action plan period. So even after the implementation of action plan, that is 2015, actually the profit shifting loss has not come down or, or not curtailed down as expected by our policymakers. So lower middle income countries lost around $99.1 billion in tax revenue due to profit shifting practices. and there are not much improvement after the post OECD BPS action plan period. So there are around 15 action plans which is mentioned in the document, which is related to limitation on interest reduction, transfer pricing guidelines, s- uh, and control foreign company regulations. Coming to the country-wise result, so the main problem which was encountered by our research is that even there are 50 countries, only 20 countries, around 19 to 20 countries data is only available. So there is a huge problem of data constraints. So this is the country-wise result. India is the largest afflicted country. So it is my country also. So this is the most affected country in lower middle income country list, followed by Nigeria. India has lost around $57.23 billion from 2010 to 2022, followed by Nigeria, $11.66 billion, followed by Philippines, $5.43 billion, and Cambodia, $3.16 billion, Zambia, $2.47 billion, and Bangladesh, $1.94 billion and $1.54 billion by Bolivia, and remaining countries, it's below $1 billion. So my conclusion is that there is the increasing substitution of FDI from tax haven has a distorting effect on FDI income in lower middle countries. So while looking at our result, the dominance of transfer pricing channel points out the inefficiencies in the implementation of transfer pricing guidelines in the OECD action plan. But contrasting to our literature, the interest payment channel is weak. There are two possibilities: whether there is an effective implementation of limitation on interest reduction rule by respective countries, or MNCs are using the transfer pricing channel more than the interest reduction channel. And the tax revenue losses, which has not came down after the reform period, have to be discussed with the effectiveness of tax administrations in monitoring and evaluation of action plan. And we all know the ongoing global minimum tax discussion has to be reviewed for analyzing the curtailment of profit shifting led tax revenue losses. So this paper is actually work in progress, and this is actually our preliminary results. So I welcome all the constructive comments and criticism and questions regarding it. It will help to improve my paper. And thank you all for your valuable time. Thank you.
Many thanks for your very interesting presentation and very hard work. I'm sorry for those that joined a bit late, but because of the presentation of the GTS advance farther than expected, we are ahead of time, so we are even more time to discuss, which can be even more interesting. I already see Arun there in the room, so if you want to make the first comments, the floor is yours. Arun, thank you for being here.
Thank you very much for the invitation, and thank you and congratulations, Paul, for your paper and your presentation. I I joined. I missed the first minutes. I thought I would join a bit before one. I'm happy I did. I just missed the introduction, but I read the paper. So perhaps that you have already answered to some of that. Your paper, I think, is a perfect illustration of the relevance of our platform. A good place to discuss between lawyers and economists, and we certainly need to exchange and to speak to each other. We lawyers have tendency to discuss the rules together with us. So I'm very happy for this opportunity. The first remark maybe is observation it is that it's very interesting that sorry,
Yeah, I think that we are
do you hear
missing
me?
you. Yeah, from time to time, your connection seems to be a bit weak. And
Do
I
you
don't
hear me, or
know.
is there
Uh, hello,
problem? Or do you?
hello, Jeroen, can you hear us? I do not know if the others are experiencing the same issues that we are experiencing here in the room. I think that all of them. Probably your connection seems to be a bit weak. So from time to time, your sound it's kind of frozen. So I don't know.
Alfredo, he's not there anymore.
Yeah.
So it may be the connection, and if he
Oh.
comes back, then
Yeah. Yeah.
because
Probably
he
he's
can
back.
perhaps join without the camera. Jerome, if you just turn off the camera, then you can perhaps,
Yeah.
because the connection is not doing so well.
Yeah, I think I've switched to another router. Hopefully it works better. Do you hear me now?
Yes, much better.
Okay, thank you. I just switched to the phone, and the phone apparently works better than the Wi-Fi. Anyway, I was just thanking for the opportunity to comment on a paper that really comes at the right time and the right place for meaning a discussion between lawyers and economists. My first observation is that you have emphasized the fact that FDI from tax haven has not decreased with BEPS, and I think that is an interesting point. We've all heard about investments coming to different countries through tax havens. We were perhaps hoping that that would decrease in the aftermath of BEPS, but apparently that was not the case, even when you're considering relatively recent data. So that was just an observation that I think is interesting for us to be aware of. My second point is that it is a good, I think, opportunity for you to present this paper, and you've mentioned that there is a work in progress. I'm happy to hear that, mainly with regard to the fact that some of the data that you are looking at concerns years when the BEPS reforms were either not in place or were going to be in place, going to be implemented, and you are aware of that fact. You mentioned in the end of your presentation that beyond transfer pricing, other types of rules were not taken into account but will need to be taken into account in the future. I'm here mostly referring to, of course, Pillar 2. That's one thing. We'll see if we still have a Pillar 2 in the future to monitor. But anyway, for now, we do to some extent. But also Action 4 with respect to limitations to interest deduction. Here, a question is, since this is a work in progress, do you intend to update the data, perhaps having like making a yearly or update or biannual update so that you keep the data as fresh as possible and take into account the impact of different reforms? I don't know if you want to answer. Maybe it's easier if we.
Yeah.
Yeah.
Thank you, Dr. Jerome, for your kind comments. So the first point is regarding the FTA from tax havens. It's actually not came down even after the implementation of action plan. So there is a problem of capital substitution. So even if a country is planning to achieve or substitute the FTA from tax havens for a non-tax haven, it's not possible because of tax treaties, and there are all kind of tax trade agreements going on. So that's an important aspect which we looked at. And second is regarding the pillar 2. So it's actually a work in progress. Our second part of our research is actually on the pillar 2, the effect of OECD action plan on the profit shifting velocity, whether the action plan actually reduces or bring down the tax revenue losses. So it's our plan, and we are planning to do it at an annual basis.
Mhm.
And
Mhm.
so we looked at three possible actions. First one is the transfer pricing guidelines in the OECD BEPS action plan and the limitation on interest reductions, and whether these two action plan has any effect on the profit shifting losses. So we have a plan to actually expand this research work into a policy perspective. So this is my preliminary level of
Very
response
good.
to your question.
Thank you. Then I have a few follow-up questions. Um, First of all, how do you define, I mean, what taxes do you take into account? I think you take into account corporate income tax. How do you then define corporate income tax, and how can you measure it in different countries? Is it what is labeled as corporate income tax, or do you assimilate other taxes, do you include other taxes as well that are taxes on corporate profits or corporate revenues, but that may not be included as such in the national corporate income tax? One may think of let's say withholding taxes, perhaps. One may think about the top-up tax. In some countries, it is the corporate income tax. In other countries, it's a separate tax. There are also gross taxes, DSTs, DPTs, etc. So here, that is a question of definition and methodology.
Yeah, it's actually a very tough question. We actually, in the last week, me and my supervisor are actually thinking about it. In the Indian context, it's only a corporate profit.
Mhm.
So the definition of a corporate income tax is very different in different countries.
Yeah. Mm.
So we are working on creating a consolidated corporate tax base, on taking a consolidated corporate tax base, which including, so let me put in this way. We are taking only the corporate tax profit of certain type of companies of the selected countries, and how these companies are shifting profit. So we are planning to make sense of a consolidated corporate tax base. So we are actually working on it. I know it's a very difficult term to define what's corporate tax, because it's very different in different countries. In some countries, it includes top-up tax also. So in the Indian context, it includes only
Mhm.
corporate profit.
Okay, so
Yeah.
you would basically report different types of taxes that you would add to each other to a by yourself computed tax base. So it is reported to profits, computed according to your own methodology, but at least you would reach some form of harmony between different countries that you're looking at.
Yeah, yeah.
Yeah, yeah. I mean, I guess there is no perfect methodology if one wants to have a global approach, but at least it gives an idea of a kind of trend. But of course, I mean, I guess in your final paper, you will need to explain the methodology and make clear what may be included, what's not included, and your choices when constructing this tax base. And the choices made, I mean, what taxes to include, what taxes to exclude, and then, of course, how to get the data. There are some official sources databases, but not everything is included there. The accounting standards might not be comparable. So, I mean, could an option be to start with the CBCR data? Um, I mean, that is at least uh, some I would say consistent, relatively consistent source of information. I don't know if one can have access to when the reports for Pillar 2 purposes are submitted. They're not public, but if there will be databases that will gather that maybe to the same extent or in the comparative manner to what is done for transfer pricing purposes. There are databases then that professionals use to gather information. So here, I guess the objectivity of your methodology will be important. There's probably no perfect method, but at least the objectivity makes it more difficult to criticize and more relevant to rely on your data. Um, Good. And I don't know if you want to comment or.
No. I'm noting down all the points. It will be helpful for me.
Then the next point would be how to assess whether, I mean, how to think about the source of the problem, the cause of the problem. I mean, if you observe declines in public revenues, no matter how we define, I mean, what types of revenues, public revenues we look at, what types of taxes we look at. If you observe a decline, how to explain that decline? I mean, you've mentioned transfer pricing. And here my first question would be, is it transfer pricing as such? Is it the pricing of transaction or is it the mispricing? Where does the problem come from? And if it is, I mean, control in the company transactions cannot be problematic as such. They exist for different reasons. It is, again, the mispricing that is mostly problematic. But then how to measure that, how to put a figure on it and say that, well, the pricing of this and this is problematic. How can you capture that information?
Yeah. So regarding the transfer pricing, so there is a transfer in the context of India. There is a transfer pricing rules. So there is a basic arm length pricing that I think we all
Yeah.
know. So in our database, there is a database called Proverse database for in the context of Indian companies. So there is a standard market rate for each type of raw materials and resources. So when we looking into the company's balance sheet, so if any company systematically deviates or misprice from the standard market rate, we can consider it as transfer pricing.
As
So
transfer
we are,
mispricing then perhaps.
yeah.
Okay.
So we are tracking down that companies and looking at their transactions in the context of transfer pricing guidelines. So this is my basic level of preparation or understanding regarding it.
Okay. Then how to make a comparative study, because I mean those benchmarks are relevant from an Indian perspective, and they may not follow the, let's say, the interpretation of the arm's length principle in other countries that may deviate.
Yeah.
And you don't have the same tools in other countries, then perhaps the fact that India represents more than half of the corporate revenue losses, perhaps it is explained by this, let's say, this methodology, this comparison between the actual pricing of transactions and what is expected in the law. Perhaps that is an explanation of why India is so overrepresented in those losses. And then my follow-up question would be, is that methodology then applicable to other countries? First, the benchmark might not be, I would say, adapted to other countries, and then the how to gather the information might be difficult if you would try to apply the same methodology to other countries.
Yeah, that's a very provoking problem which I encountered. So the standard which I measured in India is not applicable for other countries. So either I should refer the CBCR report, and actually we are working on it how to make a
Yeah.
comparative perspective on it. So we are actually working on it. So at this point, I have no a clear answer.
Yeah, I understand. I mean, I'm just basically thinking aloud, because it is very interesting to see the impact of the different reforms, and interesting to compare different countries. But we just hope, of course, that we get the correct picture, and that we can suggest changes to policymakers based on data that is as relevant as possible. So I think, yeah, here there is a perhaps potential for reflection. I mean, the very least, your methodology is interesting from an Indian perspective. It is a way of measuring to what extent the reality deviates from the theory. So that in itself is very interesting.
Yeah.
Then also appreciate that you mentioned that you would be looking at other types of rules. Monsieur, there's an echo here. I hope the connection is correct. Here you mentioned that you were aware of the fact that Action 4 and Pillar 2 were, of course, important factors. However, here my question is, I mean, to what extent can we, I would say, mix those different sources of information? Because, I mean, each one has its own logic. Of course, the whole picture is perhaps the most important, that we tackle the BEPS phenomenon with different tools, right? We hope that
Yeah.
each tool works fine, but I think it's difficult to aggregate those different sources. Like, is there a problem with the interest payments? How to answer yes or no if we consider the transfer pricing aspect, the interest limitation rules aspect, the Pillar 2 aspect that comes like as a last kind of resort. I think it's difficult to mix those perspectives.
Yeah,
But
I also think it's very difficult.
yeah, but for sure, if considering the global, I mean, the revenues, the evolution of the revenues with in the toolbox different types of rules, maybe that's enough. It's enough to give a message to policymakers, like what you've been doing during the last decade or so has worked or not. Corporate revenues have increased or decreased, and basically perhaps the method does not matter the most. I would say if the revenues that are saved from tax avoidance are saved thanks to transfer pricing rules or interest limitation rules or Pillar 2, that doesn't matter much, I guess, to policymakers, as long as we indeed protect the tax base against erosion. But it just needs to be, I think, clearly explained to the different stakeholders that will look at your research.
Yeah.
Next point here, you mentioned, I'm looking at the time, maybe I should stop at 1:30. Alfredo, if that's fine with.
Yeah, we have more time than expected, so it's okay to end up at 30, yes.
Okay, I will finish my comments at 1:30. You mentioned in the paper and in the presentation that developing countries were more vulnerable to tax avoidance than developed countries, and I certainly agree with respect to the lack of resources of developing countries, the difficulty to negotiate as part of mutual agreement procedures, and the lack of I would say match in terms of capacities. So I certainly understand this. But here my question was, to what extent could other explanations justify the picture that you observe in terms of revenues? Because I'm thinking here of incentives, tax holidays as well. That is, or might be, an explanation to I would say, variations in corporate tax revenues. And of course, there may be different patterns in different countries. Different incentives may be offered, different tax holidays may be given. So how to basically to account for the impact of these when making such a global study as you're doing?
Yeah, so in the preliminary analysis, we actually project the corporate tax revenue of, like, as a comparison, we do the corporate tax revenue of lower middle income countries in comparison with high income countries from the year 2000 to 2022. So we can see a convergence in 2015-16. But after 2016, what we see is that high income countries' corporate tax revenue actually lifted up, and it go above 3.5 to it's around 4% right now. But the lower middle countries, it is actually going down. So the matter of fact is that even after reducing the corporate tax rate by the lower and middle income countries in the last 20 to 30 years, naturally it should be reflected in the corporate tax income, but it is not reflected in the corporate tax income. So the main possibility is profit shifting. There may be other reason relating to tax administration. Whether the tax administration is ineffective in enforcing these rules is an important aspect. So we ended up in that question of that tax administration. So how to measure the tax administrative aspect? So it's the last part of my research to link the corporate tax revenue volatility with the tax administration. So this is the basic thought regarding that question.
Yeah. So here, yeah, my point is simply to mention that there may be other sources in impacting the corporate tax revenues than the tax avoidance behaviors or the I would say the well functioning of the tax administration. One of these is tax incentives and holidays, which may actually take different forms. It could be like a decrease of the corporate tax burden. It could also be a subvention. It could take different form. It could be that you get the possibility to buy land at a low price. So they can, and that of course impossible to measure in a comprehensive and objective way. Then perhaps at least one could have like a mention in the paper and on the website where you present the research that there could be different factors explaining the evolution of the corporate tax revenues, and perhaps you could nuance then your conclusions so that you do not perhaps only suggest reforms to transfer pricing rules and maybe some other anti-avoidance rules, but also perhaps open up the discussion for other types of factors that may influence the corporate tax revenues.
Yeah.
I see the time is my time is up, 1:30. Thank you very much for this very interesting presentation, paper, and good luck with the future work. Thank you.
Thank you, Dr. Jerome. Thank you so much for your valuable comment.
Thank you, Jerome, and also Paul for the reactions. Are there any other participants in the room that want to make a comment? I think I do not know yet. Yeah, Marco and Eduardo, if I see them correctly. Do you want to intervene, Marco?
No, at this point, I think that the discussion has been quite accurate and lively, so I have nothing else to add in this respect. Thank you.
Yeah.
I just wanted, if I may, Alfredo, congratulate Arun for your paper. I have two small questions, if I may. Can you hear me well, Arun? The first one, you are talking about tax havens generally, and I would suggest distinguishing at least two different categories of tax havens. I could say, on the one hand, we may find tax hubs such as Ireland, and on the other hand, pure tax havens such as, for example, Bermuda. So if you take a look at, for example, the Apple Ireland case regarding state aid in the European Union, what we can see is that tax hubs such as Ireland are serving as matchmakers between international investors and endpoint jurisdictions, for example, Germany. And the role of tax havens in that case, such as Bermuda, is basically to have a direct connections with Ireland. So my suggestion, if you agree with this point, Arun, is to, for example, take a look at my latest paper entitled Tax Hubs, in which I try to distinguish these two different type of jurisdictions, tax hubs on one side, such as Ireland, and tax havens on the other one. And my main point here is that tax hubs, such as Ireland, are serving as the matchmakers. My second and final point is, according to your paper, India is the country that is suffering BEPS the most. So my question is, why India? Thank you.
Yeah. So thank you, Dr. Eduardo. So in the initial preparation of our research paper, me with my supervisor, and he actually at the point, we have to bifurcate the tax havens. Exactly your point is we have already think about it. So there is a tax haven in the Indian city score. Not all tax havens are same. There are tax hubs and pure tax havens. So we have to differentiate between those tax hub and tax havens, because some tax havens have higher share of FDI to countries like India and some are negligible. So we are actually have a thought in our mind that we have to make a classification regarding that. Hence, coming to the second point, why India is the most afflicted country due to the base erosion and profit shifting? The simple answer is that India is the most FDI receiving country among the lower middle income countries. So that's the basic logic behind it. And there are also literature regarding the effectiveness of tax administration. Whether India's tax administration is actually efficient in curbing profit shifting is a big question, which we have to be discussed. So this is my preliminary answer to your question. Thanks, Edward. Thanks. Close.
Arun. If I may just kind of remark question, whatever, I think I found very interesting the comments of Jerome regarding how to take the data and what is the validity of the data. And I assume, or I wonder whether you could identify what was the data and the validity of the data that was taken into account in order to justify the whole BEPS erosion project, and whether you can connect what you are using and these data that were used in order to ascertain that, to identify the problem and to suggest the different measures. Another remark that for me it's kind of somehow difficult to tackle, it's the word profit shifting. What do you intend to by profit shifting? What type of assumptions do you take into account in order to consider that there is a shifting? I think that Jerome already pointed out the concept of corporate income tax, the issues and the reasons for making profits here and there, or for making profits in some territories or the other, or the use of tax havens. And the fact is that when you consider these and take that for granted, any type of exercise, it makes certain assumptions as valid. And I would like to know whether your assumptions are taken for valid considering the exercise developed by the OECD, or you take into account other type of assumptions that may be considered valid for your outcome.
Regarding the assumptions of profit shifting, we take the assumption from the basic literature. So again, the point is that we assume the corporate tax revenue loss is solely due to profit shifting. So that's our preliminary assumption. So there are some disagreements regarding it. There are other factors other than profit shifting which leads to corporate tax revenue losses, which is basically the investment climate, the political stability of a country. There are many other factors. So in the upcoming level of our work, we are actually planning to give a standard assumption and definition regarding the corporate tax base and how to define the corporate tax revenue. So this is my preliminary response to your question.
Any other issues, Jerome?
May I ask a follow-up question?
Sure.
Yeah, I'm wondering, Arun, do you take into account tax audits, reassessments, and basically final reassessments in order basically to get the whole picture of the revenues, whether they come from the yearly payments of different types of taxes, or that plus what comes from audits? Because it means since your methodology relies on benchmark between the actual payments the different levels of margins and different payments and what is expected in the law, at least I think you need to consider the two sources of income, basically, of tax revenues, both what is paid each year and then what is reassessed. The combination of the two give you the whole picture.
Yeah, thank you. I will look into that point. Thank you.
Thank you.
Any further questions? Last remarks by anyone? No? Well, if there are no more remarks, I think that we could conclude this first presentation by giving a strong applause to the candidate. Thank you.
Thank you, everyone. Thank
Thank
you
you.
all for
Good
your
luck.
valuable time.
Thank you.
Thank you. So we, according to the program, we are kind of some minutes ahead, which means that we are more flexible.